All right, my friends, so I'm driving back from Walmart, and I want to share with you what I was reading earlier this morning. There is a lot of cash on the table in U.S. corporations. I'm not even talking about the bank. Oh, you're going to sneeze. You're going to watch me sneeze. Ready? And show! Excuse me. Woo! All right, so there's a lot of cash in the corporate sector. And I was reading a report from the IMF, and I just got done in my last video bashing the IMF because they don't know any more than you or I. But at least they can still study and say this is what we see out there. And what is interesting because worldwide there's a huge amount of cash sitting on balance sheets, which is making corporations be net lenders and it's squirreling away savings more and more. And the interesting thing about that is being a net lender means they're not borrowing, they're loaning. Essentially what's happening is they're increasing their investment, their savings by not borrowing, thus they're becoming a net lender. I hope that makes sense. They're not like lending money out necessarily. And then I was reading something from an advisor perspective from I think it was Alliance Bernstein. Is that what it is? Alliance Bernstein? Something Bernstein. I forgot what it's called off the top of my head. But their economic report is pretty interesting. They show that net issue of stock, of equity, is well below normal we're going on 6-7 years now or something like that. Since 2012, I think is what it was. Well below normal. Net issuance of debt was well below normal until just like the last 6 months or something like that. And capital expenditures are well below normal. Well below normal. Now, what is all this? So the IMF is looking at the world. Alliance, it's not Alliance Bernstein. I'm drawing, what's the A? Alliance Bernstein? I don't think it was that. But anyway, whatever it is. They show that capital expenditures are well below normal from businesses. Net issuance of equity is well below normal, and the net issuance of debt has been well below normal as well, other than just a brief blip in 2013, I think, and then a brief blip. Well, it could be a brief blip now. Now, what does this tell you? That there is a ton of money sitting on the side, and it's just sitting there. And this isn't the financial sector, i.e. banks either. And you'd think banks would have a lot of money set on the side, which they do because there's not that many people borrowing. But there's so many things to learn from this. If they're not issuing securities, they're actually buying them back through share buybacks. What does that do to supply? Well, supply is being reduced. Not only are they not issuing more securities, but they're buying back the securities that were already out there, so supply gets reduced. All right, so when supply is reduced, and even if demand stays flat, what happens to price? Well, supply is being reduced. There's not that much out. I mean, just think about your neighborhood. If there's 10 houses in your neighborhood, and there's no houses for sale, all right, there's no supply. No matter what the demand is, there's no supply. Now, if you put one on the market, there's a supply. Now that supply needs to be met by demand, a purchaser. All right, so what if there's 5 people that are demanding that one house? All right, well, that's going to make the price go up. The demand is driving the prices up. Now, what if another house, wow, there's a huge, all these people are want my house, want these people's houses, so I'm going to put more supply in the market. And if the demand stays flat, it'll have a decreasing value on the value of the homes because the demand stayed flat, but the supply increased. Have a decreasing value on the price. Now, what if the demand stays flat, but the supply decreases back down to 1? You see what I'm saying? So it's going to have a significant increase on the price as long as the demand stays flat. But in the U.S., the demand isn't staying flat. The demand is growing up, is going bigger and bigger and bigger for assets because everything has been inflated. So we have a supply that's being restricted. We have a demand that's at least flat, if not growing. And we have corporate cash on the sideline, according to the IMF, across the world. That's a net lender, i.e. they're saving more and more. That's another reason why even in a deflationary economy, you got to be somewhat bullish on stocks. And I get it. You're sounding wishy-washy, Josh. I'm not. That's the thing. You got to look at this from every single aspect to ascertain, like, all right, if we go into a deflationary cycle, I'm not saying we're going to do that, by the way, but I'm saying you got to assume that net inflation is going to be low, because there's so much cash on the side, because the monetary supply has not increased, and because the M1 supply hasn't increased, the velocity of money hasn't increased, and then on top of that, we're actually taking corporations are buying back shares. There's still a lot of these guys are hugely cash flow positive. And look, I'm just thinking out loud here, but it just tells me again why I'm bullish on stocks. It's even if I'm overall thinking it's going to be a net low inflationary economy to even deflationary to some degree, but Japan-esque, I do believe in that. Stocks are still the only game in town simply because of the corporations with their balance sheets and the ability to buy back shares, which would decrease supply, and yet the demand for remaining shares is still out there. The demand won't go away because all these other corporations have this money. They're like, what do I do with this? So demand is there, if not growing, and I absolutely think it's growing. Supply is dwindling. That's a huge bonus for stocks without question. Whether or not they want to increase their dividends, I mean, that's always a problem for corporation executives, because if they increase their dividend and then bad times happen, what do? They're going to have to cut back their dividend, and then all of a sudden you have a declining share price because people say, oh, you're cutting back your dividend. I don't want to touch out the 10-foot pole. So it's hard to see dividends being increased. I mean, especially, the payout ratio is certainly not. Maybe they'll increase by 10 cents a share or something gradual, which would be nice, but it's hard to see just a mass increase in dividends, simply because they say we don't want to be held to that if we don't have the cash that we have. So what we'll do instead is we'll buy back our shares, or we'll increase salaries, and that's why you see this huge growth of earnings. Wages are growing by 3.4% year over year. That's pretty significant, my friends. That's double the GDP growth. And probably not double, but that's 1.5 times GDP. That's pretty significant. Yeah, there's a lot to comprehend here. It's interesting to me, but investment is not keeping track with normal investment, CapEx, capital expenditures. That means companies are sitting on a lot of cash. They're not investing it in building out, new buildings, investing in. They're investing, but just not to the extent they have historically. And yet their cash accounts are growing and growing and growing. And this isn't just Alliance Bernstein, whatever it's called. This is according to IMF too. And just from a prognostication perspective, you still got to think stocks are. Even if the PE ratios are relatively high historically, with all this cash on the table, supply dwindling, demand increasing, and CapEx is being lower than normal historically, you got to assume that the price is going to continue going on up. Just simple supply and demand, basic economics. But then you also got to assume the economy as a whole. I don't know, man. Hard to, at least inflationary, hard to see 3% inflation. I might need to adjust my inflations and my own financial planning numbers down to 2%, because it's just hard to see 3%, and that's what I've been doing, 3%. I think I am going to reduce that in my financial planning. I think I am going to reduce the bonds as well. The interest rates just aren't going up, and they may, but right now the current yields, I got 3% bonds, and that's if you factor in government bonds, which are by far and away the biggest debt that we have, and those bonds are not at 3%. I think I am going to reduce my bonds to 2.5 in my financial planning software, and that's if you're using my right capital. That's what it's based on. We're going to base it on a 2.5% inflation. We're going to still use a trustees report of 2.6 for cost of living adjustments on Social Security, We'll still use the trustees report on the Center for Medicaid and Medicare Services at 3. But I am going to reduce the bonds to 2.5. I am going to reduce inflation at 2.5 as well, which makes sense. I'm still going to leave stocks at 7.5. I'm comfortable with that. But anyways, a lot to chomp on. It's interesting times for sure. But as corporations pay down debt, as they have more and more cash on the side, and they're looking to use that money, they're going to say buy back shares. Inherently, probably not going to increase the dividends, but we'll buy back shares, and because of that, you should see an increase, a continued increase in share prices. I would think so. All right, we will see you next time.